Johan here. What I'm about to tell you is going to sound completely insane. After everything we just witnessed after the most violent silver crash in over 4 decades, after watching silver plummet from $121 to $78 in a matter of hours, the narrative you're hearing from mainstream sources is already shifting. Silver has bounced back to $86. That's an $8 recovery from the lows in less than 48 hours. Retail investors who panic sold at the bottom are now experiencing regret. Bears who were calling for $50 silver are suddenly quiet. And the financial media that was writing obituaries for the silver bull market is now publishing pieces about the resilience of precious metals. But here's what nobody is telling you. While you're focused on the bounce, while you're trying to figure out if this is a dead cat bounce or the beginning of a real recovery, something far more sinister is happening behind the scenes. And if the information I'm about to share is accurate, if the leaked documents and the emergency CME actions are real, we might be looking at a situation that's far worse than anyone realizes. Before we dive into the leaked JPMorgan target and the CME emergency margin changes, before I show you exactly what's happening in the derivative markets that should terrify every single person holding paper silver, I need you to do something. Drop a comment right now. Write bounced if you held through the crash and you're still in. Write trapped if you bought the bounce and you're worried. Write confused if you have no idea what's happening. Or just write Johan if you're here to understand what's really going on. Because what I'm about to reveal is going to flip everything you think you know about this market. Let's get into it. Let's start with what happened over the last 72 hours because the timeline is absolutely critical. Silver crashed from 121 to 78. That's a 35.5% decline in a single trading session. It was the worst one-day drop in the history of the modern silver market. Worse than 1980, worse than 2008, worse than the COVID crash in 2020. The selling was concentrated during low liquidity hours, it came in coordinated waves, and it triggered massive cascading liquidations as stop losses were hit and margin calls went out. By the time the dust settled Tuesday morning, silver had bottomed at $78. Then something interesting happened. Instead of continuing to collapse, instead of breaking through 78 and heading towards 60 or 50 like the bears were predicting, silver found a floor. Buyers stepped in. The selling exhausted itself, and silver started to bounce. By Wednesday afternoon, silver had recovered to $82. By Thursday morning, it hit $86. That's an $8 move, a 10.3% gain from the lows. Now, an $8 bounce after a $43 crash might not seem like much, but the speed and the character of the bounce is significant. This isn't a slow grind higher. This is a sharp V-shaped reversal. And historically, V-shaped reversals after violent crashes often signal capitulation bottoms. The weak hands got shaken out, the strong hands accumulated at the lows, and now prices recovering because the fundamental reasons for the crash, which didn't exist to begin with, have been exposed as fiction. But here's where the story takes a very dark turn. On Wednesday evening, approximately 36 hours after the crash bottomed, a document started circulating among precious metals traders and analysts. The document, which I have not personally verified but have heard about from multiple independent sources, appears to be an internal JPMorgan research note sent to select institutional clients. And according to people who claim to have seen this document, JPMorgan's commodity research team is now projecting that silver could fall to $50 per ounce within the next 30 to 60 days. $50, not 80, not 70, 50. That would represent another 42% decline from current levels. It would take silver below the 200-week moving average. It would completely obliterate the bull market that started in 2020. And it would validate every bear thesis about silver being in a speculative bubble that is now popping. Now, before you panic, before you rush to sell everything, let me walk you through why I'm extremely skeptical of this leaked target. And let me show you what I think is actually happening here. Because if my analysis is correct, this leaked $50 target isn't a prediction. It's a manipulation tool designed to create fear and drive more selling so that certain institutions can cover their positions at favorable prices. Let me explain the context around JPMorgan and silver because this is absolutely critical. JPMorgan has been the single largest short seller in the silver market for over a decade. They've been documented repeatedly manipulating precious metals. In 2020, JPMorgan paid $920 million in fines to the Department of Justice and the CFTC for spoofing gold and silver markets over an 8-year period. That's not speculation. That's a legal settlement where they admitted wrongdoing. The spoofing involved placing large buy or sell orders with the intent to cancel them before execution, creating false impressions of supply and demand to move prices in their favor. This is a bank with a long documented history of manipulating the very market we're discussing. So when a research note from JPMorgan surfaces predicting $50 silver right after the worst crash in decades, you have to ask yourself, Is this genuine analysis based on fundamentals? Or is this strategic messaging designed to influence market psychology and trading behavior? Let me show you why I think it's the latter. First, let's look at JPMorgan's positioning. According to the most recent CFTC commitment of traders data and estimates from analysts who track large trader positions, JPMorgan has been massively short silver through futures contracts. Some estimates put their short position at over 150 million ounces going into the recent crash. When silver was trading at 121, those shorts were catastrophically underwater. Every dollar silver moved higher was costing JPMorgan hundreds of millions in mark-to-market losses. They desperately needed silver to go down, and conveniently, it did. The crash from 121 to 78 moved their short positions from deep losses into significant profits. But here's the problem. At some point, JPMorgan needs to cover those shorts. They need to buy back the futures contracts they sold. And if they try to cover 150 million ounces in a rising market, their buying pressure will drive the price higher, eating into their profits and potentially creating a short squeeze. So what's the optimal strategy? Engineer another leg down. Get silver from 86 to 50. Cover your shorts at 50, then flip long and ride the recovery. But how do you engineer another leg down when you've already crashed the market 35%? You can't dump another massive wave of sell orders without people catching on. So instead, you leak a research note predicting $50 silver. You plant that narrative in the market. You let fear do the work. Retail traders see JPMorgan predicting 50 and they panic, sell. That selling drives the price lower. You cover your shorts into that weakness. It's brilliant from a manipulation standpoint. Now let me show you why the $50 target makes absolutely no sense from a fundamental perspective. Let's start with production costs. The all-in sustaining cost for primary silver miners, meaning the cost to extract, process, and bring silver to market, including capital expenditures, is estimated at around $20 to $24 per ounce for the most efficient producers. Many miners have costs in the $28 to $32 range. If silver drops to $50, miners are still profitable, but margins compress significantly. And if silver stays at 50 for an extended period, you'd see mine closures, production cuts, and a reduction in supply. That supply reduction would then create tightness that would push prices back up. So $50 isn't a sustainable long-term price based on the cost structure of the industry. Second, let's look at industrial demand. Silver is critical for solar panels, electric vehicles, 5G infrastructure, AI data centers, medical applications, and electronics. Global solar panel production is at all-time highs. China alone is expected to install over 200 gigawatts of solar capacity this year. Each gigawatt requires approximately 80 to 100 tons of silver. That's massive structural demand that doesn't go away because the paper price crashed. EV production is growing globally. Every EV contains 2 to 3 times more silver than a traditional combustion engine vehicle. Data centers for AI are being built at unprecedented scale. These aren't speculative demands, these are real industrial requirements. And that demand doesn't evaporate because JPMorgan published a research note. Third, let's examine supply dynamics. Global silver mine production has been essentially flat for the last 5 years at around 850 million ounces annually. Most silver, about 70%, comes as a byproduct of copper, lead, and zinc mining. That means silver supply is tied to the economics of base metals, not silver price. Even if silver goes to 50, you're not going to see a massive surge in new production because the byproduct nature of supply makes it inelastic. And primary silver mines, the ones that produce silver as their main product, aren't going to invest in new capacity when prices are volatile and uncertain, so supply is constrained. Fourth, let's look at investment demand. Central banks globally have been buying gold at record pace as part of de-dollarization efforts. That same trend is starting to spill into silver. Retail investors are buying physical silver as a hedge against inflation and currency debasement. And based on what I'm seeing, institutional money is starting to allocate to silver as well. The crash to 78 didn't destroy investment demand, it actually amplified it. Dealers are reporting surging orders. Premiums are spiking, delivery times are stretching. That's not what happens when demand is collapsing. So when you add up production costs, industrial demand, supply constraints, and investment demand, how do you get to $50? You don't, unless you're trying to manufacture a narrative to drive sentiment and create selling pressure. Now let me show you what's happening with the CME, and this is where things get really interesting. The Chicago Mercantile Exchange, which operates COMEX, where silver futures trade, made an emergency announcement on Wednesday regarding margin requirements. For those who don't know, margin is the amount of capital you have to put up to hold a futures position. If you want to buy one silver futures contract, which represents 5,000 ounces, you don't have to put up the full value. You put up a margin, which is typically 10 to 20% of the contract value. The CME adjusts margin requirements based on volatility and risk. When markets are calm, margins are lower. When volatility spikes, margins increase to protect the exchange from defaults. Well, after the crash from 121 to 78, the CME announced they're implementing emergency margin increases. Specifically, they're raising initial margin requirements for silver futures by 40%. That means traders who want to open new long positions now need to put up significantly more capital. And traders who are already holding positions need to deposit additional funds or face liquidation. Now, on the surface, this seems like a prudent risk management move by the exchange. Volatility spiked. Margins need to increase. Makes sense, right? But here's what's suspicious about the timing and the magnitude. The CME raised margins after the crash, not before it. If they were genuinely concerned about risk and volatility, why didn't they raise margins when silver was at 121 on the way up? Why wait until after the 35% crash? The cynic in me says it's because raising margins now serves a specific purpose. It makes it harder for longs to hold positions. It forces additional liquidations from traders who can't meet the new margin requirements. And it creates downward pressure on price at exactly the moment when JPMorgan's leaked research note is predicting $50. Coincidence or coordination? I'll let you decide. But the pattern here is clear. Crash the price through coordinated selling. Leak bearish research to amplify fear. Raise margin requirements to force more liquidations. Cover shorts into the weakness. It's a multi-pronged attack designed to maximize profits for the shorts at the expense of everyone else. Let me show you what is actually happening in the physical market, because this is where the entire bearish narrative falls apart completely. If silver was genuinely heading to $50, if the fundamentals justified that kind of collapse, you would expect to see corresponding weakness in physical demand. You'd see premiums compress. You'd see dealers struggling to sell inventory. You'd see COMEX warehouses filling up as sellers deposited metal. But the exact opposite is happening. Since the crash to 78, COMEX registered silver inventory. The amount available for delivery against futures contracts has dropped by another 8.2 million ounces. 8.2 million ounces withdrawn from the system during the crash and the bounce. That brings total registered inventory to 103.4 million ounces, the lowest level in over 3 years. So let me get this straight. Silver crashes 35%. JPMorgan leaks a research note predicting $50. And the response from physical holders is to pull more metal out of COMEX warehouses? That doesn't sound like people believe the bearish narrative. That sounds like people are getting their metal out of the system because they either don't trust it or they're preparing for higher prices. And it's not just COMEX. According to contacts I've spoken with at bullion dealers across the United States and Europe, physical demand has been absolutely insane since the crash. One dealer in Florida told me they've done more volume in the last 3 days than they did in the entire previous month. A dealer in Germany said premiums on 1-ounce coins have jumped from $6 over spot before the crash to $14 over spot now. That's more than doubling. A contact in Canada reported that the Royal Canadian Mint is backed up on orders, and delivery times have stretched to 6 to 8 weeks for silver maple leafs. The Singapore Bullion Market Association reported record trading volume in physical silver over the last 48 hours. So everywhere you look, the physical market is screaming demand, scarcity, and higher premiums. Yet the paper market and JPMorgan are telling you silver is going to 50. One of these markets is lying. And I can tell you with absolute certainty, physical markets don't lie. Paper markets manipulated by banks with unlimited ability to create contracts, those can and do lie all the time. Now let me talk about what's happening in Shanghai, because this is the ultimate reality check. While COMEX silver crashed to 78 and bounced to 86, physical silver in Shanghai has been trading at a massive premium the entire time. Right now, Shanghai spot silver is trading at approximately $119 per ounce. $119, that's a $33 premium over the COMEX price of 86. A 38.4% premium. Let me say that again, slower so it sinks in. Chinese industrial buyers who actually need physical silver to manufacture solar panels, electronics, and EV components are paying $119 per ounce. They're not paying 86. They're not waiting for 50. They're paying $119 because that's what it costs to secure physical metal in the world's largest manufacturing economy. That premium is telling you everything you need to know about which price is real and which price is manipulated paper fiction. If silver was genuinely worth $50, if the fundamentals justified JPMorgan's target, why would Chinese buyers pay $119? They wouldn't. They'd wait for lower prices. But they can't wait because their production lines require the metal now. And the metal isn't available at COMEX prices. So they pay the premium. That premium is the market's way of saying the paper price is fake. Let me give you some historical context on CME emergency margin changes, because this has happened before and it's always been controversial. In April 2011, silver was in the middle of a massive rally. It had gone from $17 in August 2010 to $49 by late April 2011. That as a 148% gain in 8 months. The rally was driven by a combination of industrial demand, investment demand, and short covering. Then, the CME raised margin requirements on silver futures 5 times in 8 days. 5 times. Each increase made it more expensive to hold long positions. The cumulative margin increase was 84%. Within 2 weeks of the margin hikes, silver crashed from $49 to $32, a 35% decline. The rally was killed. Longs were flushed out, and the market didn't recover those highs for over a decade. At the time, many people argued that the CME margin hikes were designed to protect the shorts and kill the rally. The CME claimed it was prudent risk management. But the timing and the magnitude raised serious questions about whether the exchange was acting as a neutral facilitator or as a tool to benefit specific market participants. Fast forward to today. Silver rallies from $30 to $121, it crashes to $78, and now the CME is raising margins by 40%. History doesn't repeat, but it sure as hell rhymes. And the rhyme here suggests that the exchange is once again acting to suppress price and protect the shorts. Now let me show you what the technical picture looks like, because this is important for understanding where we go from here. Silver crashed to 78, which was just below the 200-day moving average at 79. It bounced immediately, and we're now at 86. The character of the bounce, sharp and V-shaped, suggests capitulation at the lows. But we're now approaching the first major resistance zone at $90 to $92. This is where the 20-day moving average sits, and it is also a minor consolidation level from the way down. If silver can break through 92 and hold, the next resistance is at $100, a psychological level. Above 100, you're looking at 108, which is the 50-day moving average. Break 108, and the momentum could carry silver back to 115 or higher. But here's the problem. If JPMorgan's narrative takes hold, if the $50 target gains traction, and if the CME margin hikes force more liquidations, silver could fail at this 90 to 92 resistance zone and roll over. A failure here could take us back to test the 78 low. And if 78 breaks, the next support doesn't come in until the mid-60s. That would validate the bearish scenario. So we're at a critical juncture. The next few days of price action will tell us whether the bounce is real or whether we're heading for another leg down. Let me tell you what I'm watching obsessively over the next week, because these signals will determine which scenario plays out. First, can silver break and hold above $90? If yes, it confirms the reversal. If no, we might be setting up for another drop. Second, does COMEX inventory continue to decline? If another 5 to 10 million ounces leaves the warehouses, it validates physical tightness. If inventory stabilizes or increases, it weakens the shortage thesis. Third, do Shanghai premiums stay elevated? If they remain above $25 to $30, it confirms the paper physical divergence. If they compress to single digits, it suggests the physical market is less tight. Fourth, what happens to retail dealer premiums? If they stay high or increase, it confirms robust physical demand. If they drop back to pre-crash levels, it suggests demand is weakening. Fifth, watch the mining stocks. If miners outperform silver, rallying harder than the metal, it signals institutional confidence. If they lag or decline, it suggests skepticism. Sixth, monitor the CFTC Commitment of Traders report when it's released. If commercial shorts have decreased significantly, it confirms institutional covering and potential flipping to long. If shorts remain elevated or increased, it suggests the bears are doubling down. Now let me address what you should do if you're currently holding silver or considering entering positions. I'm not going to tell you what to do, because that's not my role and it's not appropriate, given everyone's different risk tolerance and financial situation. But I will tell you how I'm thinking about this, and you can decide if it applies to you. First, if you hold physical silver, I would not sell based on a leaked JPMorgan research note. Physical metal is scarce. Premiums are high. Shanghai is paying 119. The physical market is telling you the real value is far higher than 86. If you're going to stay in paper, use tight stops, manage position size carefully, and don't over-leverage. The risk of another forced liquidation is real, given the margin changes. Third, if you're sitting in cash considering buying, recognize that we're at a critical technical juncture. Buying at 86 with resistance at 92 carries risk. But if you believe the physical market fundamentals, buying at 86 with a stop below 78 might be a reasonable risk-reward setup. Or you could wait for confirmation of a break above 95 before entering. There's no right answer. It depends on your strategy and conviction. Let me give you the 3 scenarios I see playing out over the next 30 days, because understanding the range of outcomes is critical for positioning. Scenario 1, the JPMorgan narrative wins. Fear takes hold. The CME margin hikes force more liquidations. Silver fails at 92 resistance and rolls over. We retest 78, break it, and head towards 60 to 65 before finding a bottom. In this scenario, the physical shortage eventually forces a reversal, but not before more pain for longs. Scenario 2, we consolidate here. Silver trades between 78 and 95 for several weeks, while the market digests the crash and the bounce. Physical demand continues to absorb supply. Shanghai premiums stay elevated. Eventually, the paper market runs out of sellers and we break higher. This is a slower grind scenario. Scenario 3, the reversal is real and violent. Silver breaks 95 next week, clears 100 shortly after, and makes a run back to 115 plus within a month. This scenario happens if institutional buying accelerates, if physical tightness becomes undeniable, or if something breaks in the delivery mechanism at COMEX. Based on the evidence, I'd assign probabilities of 20% to scenario 1, 40% to scenario 2, and 40% to scenario 3. The key is staying flexible and adjusting as new data comes in. Let me tell you what my gut says, because sometimes you have to trust pattern recognition beyond just data. I've been watching these markets for years. I've seen manipulation. I've seen legitimate crashes. And I've seen manufactured fear campaigns designed to shake out retail before big moves higher. This feels like a manufactured fear campaign. The timing of the JPMorgan leak right after the crash and the bounce, the CME emergency margin hike that makes it harder for longs to hold, the mainstream media amplifying the bearish narrative. It all feels coordinated. And the physical market data, the inventory declines, the premium explosions, the Shanghai disconnect, it all contradicts the bearish story. My gut says JPMorgan is trying to engineer one more leg down so they can cover their shorts at better prices before the market rips higher. But guts can be wrong. That's why you follow the data and manage risk.